Hello traders, Steve Ganz coming to you from Big Bear, California. It was a little too hot down in Southern California, or down in the lower levels of Southern California. So up in the mountains here right now where the temps are a little bit cooler. So anyhow, I'm going to continue on with our compare and contrast series. And I'm going to start getting into things that surround long stock and ways that, kind of comparing, for example, a short put to 100 shares of long stock. We'll also look at a few other things in this particular series. Synthetic stock. How do we do an options position that can potentially work the same way as stock? Many times for a lower cost to entry. So the biggest thing that I want people to understand here, when most people talk about options being scary or something that is dangerous, the short put is probably more often than not what they're talking about. It's either going to be the short put or the short call. Those are the two what most people would consider two of the riskiest options positions out there. Now, when I say riskiest, owning 100 shares of stock is risky too. So what I want to do is I want to compare in this specific example today. It's going to be relatively simple, relatively short. We are going to look at the difference in owning 100 shares of Apple stock versus selling a put in Apple stock. So let me just expand this here. I can adjust my screen size here. Well, first of all, look at if we buy 100 shares of Apple stock, we're going to tie up $18,804. That is the price of Apple today, is $188.04 per share. And as we all know, when we're dealing with an option represents 100 shares of stock. So whatever you do with an option, and unless there are some very rare exceptions out there, there are something I think called micro options that they tried playing with a few years ago that I think represented 10 shares. I don't even believe those exist anymore. So for all practical purposes, we're going to assume that anytime we're talking about an option, that is representing 100 shares of stock. So the most important thing we have to understand is if we're going to use an option as a possible replacement for stock, or maybe a way to enter a stock position, we have to compare it to 100 shares of stock. And if we're going to, as I'll show you in a moment, sell a put with the possible intent of entering a long stock position using that put, we have to be prepared to pony up the amount of money it's going to take to buy those shares. So we come back to our Apple here, long stock, $188, it's now 6 cents. So we essentially, for all practical purposes, we have $18,806 on the line. If Apple went out of business, that would be our loss. Now, obviously, Apple's not going to go out of business. They could have a huge tank in the stock price. They could have a huge run up in the stock price. Both of those are possibilities. And if I am short, if I own the stock and the stock drops to 150, well, I'm going to be out $3,800. If it runs up to 230, well, I'm going to be up $4,000. Okay, so I know that this is one-dimensional. I'm only going to make money when the stock goes up, and I will lose some money when the stock goes down, and I'm essentially tying up $18,800. Now, what I like to show people is many people think that options are riskier than stock. Well, I'm going to show you why they're not. So in this particular situation here, if I sold a short put, sometimes they call it a cash secured put on Apple, and I sold that put at, I don't think there's an interim price here. So again, Apple's trading at 188. I'm going to sell this put at 185. I'm going out about 40 days, and I am going to bring in, to sell this put, I'm going to bring in approximately $400 in credit. So in this scenario, if Apple totally tanked to the point where they were going to go out of business, my loss would actually be less than if I owned the stock. The reason it would be less is over here, I'd have $18,800 tied up. Here, I've put up $18,500 in collateral. I took in $400 in credit. So basically, my max loss over here is going to be less. It's going to be around $18,400 or $18,500, somewhere in that range, because it's going to be offset by the amount of credit that I took in for this put. And the same holds true pretty much anywhere along the way here. If we go down to 160, we're going to be down $2,094. Over here, if we go down to 160, we're going to be down $2,820. So we're going to be down a little more money here, because here again we have this credit we took in that offsets the loss that's occurring in that stock. Now, in exchange for that, what are we giving up? If we're going to get this $400 in credit, what are we giving up? Well, we're giving up an upside. So if Apple were to move up or stay, in this 182, 183, 188 range, I'm going to make $400 just off of theta decay, what I sold this for decaying. So in a period of 40 days, I will make $400 on this position if Apple does not tank to where I have that stock put to me. So over here, if Apple's price stays right where it is, I get nothing. There's no P&L that occurs here. I have to have the stock go up in order to make money. Again, here I don't have to have the stock go up. It can just set right where it's at and decay, and I'll make $400. So we're going to talk about this in a subsequent session, and how many people will use this strategy as a potential entry into a long stock position. And if I sell this 40 days out and I sell 185 and Apple kind of stays in this general range and I get to keep my $400, I'll just go out and I'll sell that same thing again, and I'll sell it again, and I'll sell it again. If I want to own this stock, and I'll just keep selling it month after month after month until the stock finally gets put to me. And of course, I can change my strike. If Apple moves up to 195, I'll be able to close out this position much sooner than 40 days then, and then maybe I'll sell a 190 put. If Apple moves up to 215, maybe I'll sell a 205 or a 210 put, because maybe I'm willing to buy Apple at 205 or 210 at that point. The key aspect of this being that each time I do this, when I get a net credit of $400, keep in mind that's $4 per share. Okay, so each time I'm able to do this, I am reducing my cost basis in Apple by $4 a share. So let's just say Apple didn't change in price. It just sat here at the 188 range for the next 4 months, and I did this move 4 times. I sold a put at 185 4 different times. That would be $1,600 or $16 per share. And then all of a sudden, one day, Apple does get put to me. Apple drops down to 184 or 182 or whatever, and I'm forced to buy it at 185. Well, if I went through that process 4 times, I reduced my cost basis by $16 a share. So even though this says, even though I've got to pay 185 for it, if I was able to reduce my cost basis 4 separate times, $16, I'm actually paying $169 for Apple stock at that point. That's what my effective cost basis in the stock would be. So again, this ultimately this is part of what's called a wheel strategy, and I just wanted to, for today, again, we'll carry this a little bit further in the future. For today, I just wanted to compare and contrast how 100 shares of long stock compares to selling a short put. And again, the key aspect here is if we can sell this short put a few times before we were to ever have the stock put to us, well then, here our max loss would have been $18,800. But again, if I could make $1,600 along the way, before that stock ever gets put to me, my cost basis or my maximum risk at that point is about 16,000 and change as opposed to 18,000 and change. So hopefully that makes sense. As always, please like, subscribe, and of course, make some comments down below. If you have any questions, post those as well. I'd love to hear from you, and we'll look forward to continuing this compare and contrast series, specifically around long stock and some different things that people might consider doing with long stock. So that's it for today. Thanks, everyone.